Hello everyone and welcome to J Sanderson TV, episode 5, 2021, and it's great to be back out and about in Melbourne in a somewhat reduced capacity after a lockdown hit, Roy, between now and the last time that we were here. Welcome, it's good to have you back in our office.
Thanks, Dave. Great to be back here for our end of financial year special, so looking forward to it.
Roy, the lockdown, it kind of came out of nowhere. We were sort of tracking on a pretty positive upward trajectory. Life was sort of going back to the way that it was before COVID, and then suddenly out of the blue, we were back in familiar circumstances. How did you and how did your team cope with lockdown 4?
So as an accounting firm, we had to close our offices to the public, but that's okay. We were all working very hard from home and nobody got any time off because there was certainly lots to do. On a personal level, I found it a little bit difficult, but this time, lockdown number 4 in Victoria, I was having a healthy green smoothie every morning for breakfast, and that was wonderful, but my wife says that they're actually called mojitos.
Geez, I wouldn't mind having that smoothie for breakfast myself. No wonder you managed to get through, and no wonder the team managed to get through as well. They probably had a pretty happy manager all that time. Roy, let's get into our news headlines because the Q3 economic indicators are out, and it paints an interesting picture about Australia and how we're performing both nationally and on an international level. And we'll start with GDP. We'll start with consumer confidence as we always do, because this is an interesting graph and it's been a great yardstick in terms of measuring people's relative confidence considering the circumstances. And actually we see consumer confidence today at a 5-month low. The reasons cited have been the Melbourne lockdowns and also the response to the federal budget. What do you make of it?
I'm surprised that we're at a low, but if we think about what we've been doing over the last 5 months, we were actually surprised that we were so high given COVID and what was going on around Australia. So maybe it's a little bit of coming back to normality rather than being an all-time or a 5-month low. It's more normality, I think, would be the right answer.
Measuring confidence is a difficult thing to do. So I thought I'd have a look and see what the components are that make up the consumer confidence index as we see. And here's some of the factors. There's 5 factors: family finance versus a year ago, family finance projections for the next 12 months, economic conditions for the next 12 months, people's perceptions of economic conditions for the next 5 years, and the most telling component of it all, is it time to buy a major household item? So people are going to go out and buy a TV or a fridge in the next month.
It's interesting that you've drilled down to that level, because measuring consumer confidence, in my opinion, is quite a difficult thing. But as long as you've got a consistent set of questions, then you can actually measure whether we're up or down from month to month, and I think that's important.
Consumer confidence and household spending are very much interlinked, so I thought we'd have a look at how household spending and expenditure is tracking, because this is interesting. So whatever the value is there, whether that's millions, billions, trillions, again, like it's a consistent indicator, so it gives us a yardstick. You can see there we're at 268,245, and we've started to track upward again in terms of the total output of household expenditure. But you can just see that the recovery is still not quite at pre-pandemic levels. December 2019, the level was 272,204. So although expenditure is tracking upwards, we're still not quite at household expenditure levels that we saw prior to the pandemic. Now, one thing we've spoken about on this show a lot, Roy, is that people were saving a lot of money during the pandemic. Actually, total disposable household income went well up, and that was driven by government stimulus. But people are saving a lot of money and they're not spending it, which we know doesn't support the virtuous cycle of the economy. So it'll be interesting to see how this lockdown can continue to impact expenditure.
And I wonder if that's partly because the public are looking at this and seeing that every now and then there's an immediate lockdown. A state closes down, Victoria goes into lockdown, a border gets closed. And I just wonder if people are concerned about spending money straight up, or whether they should just hang on to it for emergencies, just in case things go sour.
And you do feel like you need that money. As an example, you know, we've had wild weather as well in Melbourne that's torn apart places, and I'm sure that there's people that, you know, having to pay the repair costs, but then also there's the cost of lost income due to caring for children, and we know that there is government stimulus packages available, but it is sometimes difficult to access, and sometimes people don't qualify, so they hold on to the money that they can when they can.
Yes, and I think that's quite likely what's happening at the moment, where people are saving it for emergencies. I think COVID's probably the biggest thing, but certainly the weather and the problems we've had in Victoria have certainly played a part in the Victorian economy, I think.
I know you've got some thoughts on the COVID situation and how government and officials should respond to that, and we're going to talk about that and also some of the interesting stats that are coming out of the whole COVID situation later on in the show. But if you do have a question, please put your question in the comments and one of the J Sanderson team will jump on to answer that one. Let's move on to GDP growth rate. Again, third consecutive quarter of growth now. We're out of the recession. The recession's well behind us. And although it's modest growth in comparison to the last two quarters, Roy, the number of 1.8 is actually up on the expectation, or the market expectation, which was a growth rate of 1.5%.
We have said this before. We've actually got the Nike tick coming out of the recession. The recession was big, it was huge, it was deep, but it was quite quick. We've bounced out of it, and I think we're going to see over the next few months that graph just getting closer to back to what I would call normal, around the 1%.
Unemployment rate is another factor that we look at on this show. We don't have up-to-date numbers as yet. The May number hasn't come out as we go to air. So it's still sitting at 5.5%. The expectation, though, is that unemployment rate will remain pretty steady at 5.5%. So, again, nothing really to write home about there. But moving on to business confidence, this is a graph that we haven't shown. And I thought, you know, every week or every month, I should say, we talk about consumer confidence. So let's have a look at business confidence. You can see there in July, the number went through the floor as expected and as all indicators did, and now it's still quite high comparatively, but a slight drop off during the May month.
Yeah, business confidence are very different to consumer confidence, isn't it? Certainly would have other factors apart from what we talked about earlier in your consumer confidence questions. I think it's great that confidence is still quite high in the business sector, and I'm not sure what is going to happen, COVID as an exception, that could knock that around a bit. So it should still stay high.
Business confidence also, in large part, is going to be driven by overseas markets, particularly when we know that some of our biggest companies are miners, and the price and cost and supply of things like iron ore and lithium are going to move those indicators a lot. And we saw that in the last number. The changes or the slight decline in business confidence was led by falls in mining and finance, business and property through construction, and then retail and recreation were also lower. So those are just a little snapshot of some of the things that affect business confidence. Another thing that we talk about on this show, Roy, is the inflation rate, and it's basically you and I we're slightly on edge about this one because. We know that the Reserve Bank has indicated that they're not changing interest rates at all. We know that there's record government stimulus out in the economy. We know that people have saved a lot of money during the pandemic, and that household income actually went up. So the big question is, is the government going to manage inflation? Well, you can see there that it's still currently very low in comparison to what it's been historically.
Yes, and also it's well below what the Reserve Bank targets are, which are between 2 and 3%. So we've got a fair way. Inflation will go up. They're certainly planning for it to go up, given it's a 2 or 3% target.
Those are some of the economic indicators, and it's always fascinating to see how those graphs play out. But also, Roy, you mentioned off the top, it's the end of the financial year coming up. The end of the financial, we know what we do at the end of the calendar year. We count down. What's it like at an accounting firm? Is there a bit of a countdown and a party?
We don't do a countdown, but we certainly party. It's New Year's Eve for us, end of financial year. So all our offices will have some sort of function, a gathering, a dinner. At the Sanderson household, we will have party streamers on the 30th, maybe a champagne just to celebrate the end of financial year.
Well, what about the pep talk? You've got to give the troops a pep talk. We're going into the first quarter of the grand final in July. Is that the type of rev up that you have to give them?
No, I think our team are pretty motivated. It's a busy time for us come July. We do lots of personal tax returns. A lot of the business tax returns seem to wait until the end of July or end of August before we get into those. Our team's pretty motivated. It's an exciting time. I will say, though, we work long hours through winter. You blink and you're past winter, so it's pretty good.
And you've mentioned in the past that a lot of your calculators and tax calculators in particular, they obviously need to update between 30 June and 1 July. It just takes me back to the turn of the millennium. Remember the millennium bug and the potential issues with that? You haven't had any issues with that before?
No, that was certainly something that was a what do they call it?
One of the great non-events.
Yeah, one of the great non-events. Perfect. Certainly there was nothing to worry about as far as millennium. And June 30 rolls over from year to year quite seamlessly for us.
There's plenty of changes to how tax is going to affect businesses, and recently you've held a webinar on tax and how it affects businesses, and there's a couple of key slides you wanted to point out. In particular, the changes to company tax rates is the first topic. Yeah,
I just thought from a company tax point of view, this webinar had 26 tips on it, of which we're going to cover off 2 or 3 today. And I just want to point out that the company tax rate is on its way from 27.5% to 25%. And that's just where it's going. There has been talk in international media about governments all around the world should actually have a uniform company tax rate, which would be an interesting concept. It would mean places like Dubai or the Seychelles Islands, where they are tax-free countries, would become almost irrelevant because everybody would agree to the same tax rate.
Geez, that'd require some sort of consensus. It'd be very interesting. Another thing that you want to mention is there's a deadline impending for super that's coming up, and employers need to make a super payment very shortly to realise the benefits this tax year. Yeah,
I thought I'd mention just points 10 and 11 from our presentation, which is available on our website if you go to our website at rjsanderson.com.au. But point 10 was, we all know that superannuation's got to be paid by, the June super's got to be paid by, I think it's the 28th of July. But if you pay it before June 30, you get the tax deduction this year, because super is one of those items that you don't get a tax deduction until it's actually paid. But don't pay it on the 30th of June because it needs time to actually arrive in the super fund's bank account. So pay the June super on the 25th of June. Point 11, I think, is a little piece of gold. Not a lot of people know about this one, but if an employer gives a bonus or a voucher, not a bonus, not a cash bonus, a voucher, it might be Harvey Norman, it might be Bunnings, it could be Dan Murphy's, and if that is $299 or below, it is tax-free to the worker and it's a tax deduction to the employer. So no doubt, your vouchers from SEN are in the mail. You'll have those before June 30. And SEN or the employer don't need to pay fringe benefits tax on them. So it's a win-win situation.
Hopefully it's a Dan Murphy's one, and I might be able to get myself a couple of mojitos for breakfast for the next lockdown.
Very good.
Hopefully that's not coming up, though. Instant asset write-off, it's a topic that we've talked about a lot on this show. It's a great benefit for business, and there's another, obviously, a tax incentive there for businesses. Yeah,
I think slide point 13, as part of our presentation, I just wanted to point out that the trick here is that it's not just about paying for the asset before June 30 to get the tax deduction. It must also be delivered. So you can't pay for it on June 30 for a new car, get it in July. That would be deductible in the next year. And I just wanted to point out also that for motor vehicles, there is if it's a 1 tonne or below vehicle, then the limit is 59,136 that you can claim. So very important that you act fairly soon if you want to claim these assets in this tax return.
So that's a really interesting point that you make there. So the asset actually has to be delivered for you to realise the instant write-off during this this financial year.
Correct. And it's to prevent people or businesses paying for stuff in advance to get the tax deduction, knowing you can't get it to next year.
I feel like that's a really strong message that you need that we need to make for people like tradies in particular. You know, that they're potentially relying on, you know, on retailers sending things out and the post as well, which we know has been interrupted through COVID. So it's an important message. If you're a tradie and you want instant asset write-off, make sure you put your orders in now so that it gets delivered to your house and you're not waiting on the delivery on July 1.
And if you were looking at purchasing a ute of some sort, it may be too late because a lot of traders have already put in their orders, so you may not get delivery before June 30. But if you're going to buy a car, make it conditional on delivery before June 30 if it's important you get the tax deduction this year.
Interesting. I mentioned off the top that you can submit your questions at any time, and we do have a question that came in from last time that we wanted to bring up. And the question says, I have around $200,000 in my super with my husband. Is this enough to set up a self-managed super fund, and can I then buy an investment property?
The answer to this is the ASIC have given us a guide that says 200,000 is what you need to set up a self-managed super fund, and that is just a guide. We do have some clients who have set up super with about 180,000, which is all okay. And the answer is yes, you can buy a property, and around the 200,000 is about the minimum because you can't borrow 80% or 90% when it's a self-managed super fund loan. You can borrow around 60 to 70%, but preferably the lower the better. So with 200,000, the answer to that listener, yes, you can set up a self-managed super fund. Yes, you can buy an investment property. But we have a kit, a very informative kit. It's only about 10 to a dozen pages about self-managed super funds. I would suggest if you send through an email or jump on our website and request the kit on self-managed super fund, it's important to read the kit first because then you'll know that what you can and can't do with a self-managed super fund.
And we mentioned the website before, rjsanderson.com.au for that kit, and then also to look to watch the full webinar on all the tax tips for businesses on the website. Roy, we've mentioned the COVID situation here in Melbourne. It's not great. Like we're not reinventing the wheel by saying that. I think everyone's well aware of the situation, but we thought we'd just delve into some of the numbers to give it a bit of perspective, starting with COVID cases by state. And it's a pretty striking graph, isn't it? You don't get any prizes for guessing who the red line is there at the top.
Yeah, disappointing comparison of state by state. And as a Victorian, you just wonder what has gone wrong for Victoria to be now in 4 lockdowns, and I feel sorry for so many businesses in Victoria. It's been very difficult, but yeah, that's a very telling graph.
You feel like the way out of this is through vaccination, and there's obviously a massive push at the moment to have as many people vaccinated as possible. We've seen in WA the age restriction on Pfizer vaccination has decreased. We've also seen that in Victoria and in other parts of Australia. So just to give it a bit of perspective of how Australia's going on the vaccination trail in a global sense, just above 22 doses administered per 100 people. Now we know that this is not a race to 100, this is probably a race to 200 because each of the vaccines that we have on offer at the moment require 2 doses for vaccination. So here's a look at the USA, 92 doses per 100 people and a significantly higher population than Australia. So you can see that we're significantly behind them. The UK is another developed nation similar to Australia with vaccination rate of more than 104. And then here's a look at some of the top 15 nations in terms of their vaccination. You can see the UK is there in the top 10. Obviously, a lot of these places are quite small in size, but yeah, Australia a long way down that list. So there's a bit of work to catch up on that front.
I think this is the bit that scares me the most because we can't keep having lockdowns in Victoria or Australia for that matter. I think that if we don't catch up on vaccinations and push those really quickly, then we have the danger of COVID hitting us again and again and again. So we need to make sure we're catching up with some of those other countries, which interestingly have a lot more COVID cases than we do, but they're a lot more advanced on their vaccination rates, and we need to improve our vaccination rates.
I heard an interesting story about a concert goer in Brooklyn. So we know that New York was pretty much annihilated by COVID at the start, and this concert goer at Brooklyn went to book tickets online, had to enter the normal details, name, phone number, credit card details, all of that, but they also had to select their section that they wanted to sit. And this is where things got interesting. You could sit in AstraZeneca 1, you could sit in Pfizer 1, you could sit in AstraZeneca 2, Pfizer 2, or you could sit in unvaccinated. Now, apart from the fact that we're going down a very interesting ideological path where we're segregating people by their vaccination status, which is a topic for the J Sanderson philosophical TV on another time, Roy, but there's a really interesting business case out of this. This is a small concert provider or entertainment provider that has a system. They've built a system or a process that is actually catering for COVID that's stronger than any of the processes I've seen personally in Australia. And we're actually starting to see Australia move down the rankings of COVID safe in terms of national capacity. And we're seeing countries that, as you said, have been hit hard by COVID moving up because they've learned to deal with it. They've built sustainable processes and practices around it, and they're actually managing it better than Australia can because we don't have the experience with it.
Very interesting that we would segregate, or they have segregated based on COVID. That's a concept I hadn't heard of until you've mentioned it. And you could expand that to when we have a day when we're going to go to Dan Murphy's or to Coles, that we would actually say, well, this particular Monday, this is if you're had this vaccination, or you're non-vaccinated. We have a non-vaccination day at a particular shop. I don't know whether we'll get to that, but it opens a whole new options on what might happen as we travel from today, where we've got a very small number of vaccinations, to where we need to be as soon as possible, where everybody's vaccinated.
I suppose it also brings up the point of incentivising vaccination. Now, we know in countries like America, they are incentivising vaccinations with cash payments, etc. But maybe Dan Murphy's is only open for AstraZeneca and Pfizer vaccinated people Monday to Friday, and non-vaccinated people you have to wait till the weekend, and they might miss out. I don't know. Or potentially, maybe the footy clubs might have to push it. If you don't get vaccinated, you won't be able to come to footy and support your team. So some interesting potential areas for incentivising.
I think we're moving into a whole new world of possibilities.
Roy's Rage is a part of the show that I really love because this is when you come off the long run, you get fired up and you talk about something that has been grinding your gears since the last time we spoke. What's on the agenda for Roy's Rage today?
Well, very much so. We've had Victoria in lockdown number 4, which has been very, very frustrating to have a fourth lockdown in Victoria. The effect on businesses has been so large. So my rage is that we have a public servant, and even though he may be very, very good as a public health officer, my concern is that the person making the decision has no business experience. He's not worried about business at all. And I believe we need a board of some sort before we have any further lockdowns. Not one person's decision, but actually a board, so that we can try and counterbalance the negative effect on business, the negative effect on tourism. Country Victoria are on their knees, and they've got a fourth lockdown over a long weekend when they would have been screaming out for people, tourism and money to come into the local economies in Country Victoria. So my rage is really, I think we're past having one person making that decision, and it needs to be a group of experienced people, including medical, but including business and others.
Is there, outside of business and medical, what are some of the other sort of stakeholders you think need to be represented on that?
Well, I get it, the government should be there, maybe local government, maybe somebody from tourism, because it's not about... not everybody agrees that the lockdown was the right thing. And I get it, that what they will do is they hang their hat on it and say, well, look, we've got no cases, therefore we did the right thing. But there have been people that have travelled from Melbourne to Queensland, and on that trip where they stopped various places, there were no cases transferred. So maybe we don't have all the facts on COVID transference, and we just need more people to make the decisions.
Okay, well, that's Roy's rage, and it was a good one. I think it's an interesting point you raised with an independent panel to judge on lockdowns. Katrina Pullbrook is well known to people who already work with J Sanderson, and she's here to give us a bit of advice on the stock market at the moment. Katrina, welcome to J Sanderson TV.
It's a pleasure. Thanks for having me.
Katrina, the stock market is at all-time highs at the moment. Does that mean it's the time to sell is the big question? What's your advice on that?
That's a great question, actually, because people are looking at the stock market thinking, I've made profit, I should sell. The question really is, do you need the money? If you need the money, obviously it is a good time to sell. But what's more important is, where is the market going from here? The market may have gone up significantly, as we've seen this year, but where is it going to next? And you could step out of the market for a short period of time and suffer from the fact that you've left it in cash and haven't purchased another stock or whatever you're going to do at an appropriate time. Here it comes. It's just have very good quality investments right across the board, very good quality ones. Hang on to the best ones and don't sell them unless something's happened and you're absolutely desperate.
KP, thanks for joining us. What do you believe is causing the market to be at record highs? Is there any thoughts on that?
Yes, it's an interesting thing when we look at the market as a collective, and it's right across the entire index, which is a collection of all the different shares. We're actually seeing some shares that have sailed through COVID-19 with a dip in the market and have done extremely well, and we don't need to point them out. They're the commodities that we've been using on a day-to-day basis that are still doing very well. Coupled with the fact that we've had low interest rates, and with continuing low interest rates, which is also helping out companies at the moment, we're seeing better dividends, and this is spurring people on to invest. And of course, you know, people joining the market obviously pushes up the market, and the valuations of companies are also quite strong as well. So at the moment, we're seeing that the market is become quite buoyant, and really we can shut the door pretty much on COVID-19 2020.
That's a big statement, KP. So you think that, are you sort of suggesting the market has now factored COVID? And this is interesting because, you know, Roy and I were also talking about this. We've seen businesses kind of adapt to COVID, and we've seen new policies and procedures. So your view is that the market's now amended itself for the correction of COVID, and it's onwards and upwards from here?
Of course, but we've got to remember that the market is a diversification of a lot of different asset sectors. And therefore, we've seen during COVID, we've seen some particular stocks do extremely well, especially around communications, of course, and also those ones that became very popular during the COVID-19 drop in the market. So if we have a look at the individual stocks, we might see some that haven't really quite recovered from COVID, but the index, being a collective, is also showing stocks that have far surpassed. So it's basically just changed. The whole market has changed its dressing, I should, probably a better way to put it, and it looks very different now. What's a good stock? What's a bad stock? And I think going forwards, we're going to see those trends really shift. And it teaches everyone that we really need to have diversification across our investments in a very big way. That if we're sitting very heavily, as we all used to do years and years ago, we would sit quite comfortably with bank stocks in our portfolio. I think that was great. But going forwards, really we're going to have to see that a diversification across different asset sectors is going to be the way we're going to have to go to meet every type of market condition.
KP, I see a lot of your investment plans and your famous roadmaps to retirement and beyond. And I've noticed that you will often recommend shares in other countries. Can you explain why that is and why not just stick to Australia?
Oh, of course. I mean, Australia, we're such a small little tadpole in the big pond of the world investment. We're only 2% of the global world market here in Australia. So whereby it's lovely to invest in our own backyard, we understand it, we see the companies, we really get it. We've got those beautiful franking credits, those tax credits that we can use at tax time. The global market offers us a bigger range of extremely good companies things we do use on a day-to-day basis, and they're extraordinarily big and give very good income and growth as well. We've seen some spectacular results that have come out of the international market because the world itself is preparing and hedging to come out of COVID-19. Just commodities we use on a day-to-day basis. Every time you get up in the morning, you might touch your iPad, the phone, certain commodities in the refrigerator. All those sorts of things that we use are really global companies, and hence we're able to leverage off the bigger stage. There's also an opportunity to, when I'm saying doing this, I'm not saying everybody go out and do their own thing. Very, very important to make sure you have that managed properly. There's some risk involved in overseas, but if you use professionals, it's done very well, because we've got to remember we're using different exchange rates across the board.
KP, when you've got a client on board and they're perhaps got some trepidation about moving into the market, how do you manage that, and how often would you chat with your clients?
It's a journey, and as Roy said before, it is a roadmap that we start the clients on, and everybody's different. And nobody needs to feel embarrassed about what they know or they don't know, because the whole journey is a learning curve. So we do roadmaps or strategy documents for people and help them with their futures. But what's important is every step along the way, they need to understand and they learn. And we put it in language that they can understand it. And if they don't understand it, they put their hand up and ask questions. It's so important that, from a duty of care from my profession and our business, that our clients fully understand where they're going, and the whole roadmap will take them through a journey that we constantly review. Year after year, we may see the clients twice a year, 3 times a year, depending on what they need, to make sure that they stay on track. It's no good setting up strategies for people around investments and their whole structure, and then just letting it go to the wind and hope that it's going to be okay. As they say, Neil Armstrong just didn't set the autopilot, when he was going to the moon, he was up there to steer it, and that's what we do. We make sure that we help you as best as we can to get where you need to go.
KP, just before we let you go, I wanted to bring up a couple of graphs and charts that sort of indicate where the local markets are at the moment. In particular, some of the returns. We see here that the markets are up. The Australian market this year is up week on week, month on month, year to date, and for year on year. And then the upwards trend in the market is quite obvious. Tell us a little bit about your analysis of those two.
I think you'll find that the most of the growth has actually come this year. COVID-19, as we know, really sort of sunk down around about late March, early April. I always relate people back to looking at one specific stock, which is a CBA share. Back in January, it was trading about $86. It hit bottom around about March. It was sitting on about $58, and it's over $100 today. So the fear of COVID-19 and the virus that came through, which is really what caused it, it was the uncertainty of what was going to happen, came through and went, and it's caused a surge. It's made people be a little bit more local when they're spending, and it's a real band together. Going forwards, though, we are going to see some strong growth in our markets going forwards. The only thing that will happen is, something untoward that we're not expecting, and God forbid we get another outbreak and we've got to shut down again. I don't suppose we'll handle that very well, or some sort of natural disaster. But we're pretty resilient at this stage. Of course, there's going to be some areas, we know that around hospitality that have done it very hard. We appreciate that. But if we're looking collectively at the whole diversification of the market, it's been doing very well. The growth will slowly come down from those figures that we've said, as we know, and that will hinge very much around, rising interest rates, etc. But, at the moment, while interest rates are low, the companies are accepting that as well. That's making a big difference.
KP, been great to chat today. Thanks so much for joining us on J Sanderson TV.
Absolute pleasure. Lovely to be here. Thank you.
Katrina Pullbrook there, an executive planner with J Sanderson TV. Some great insights there, Roy.
Yeah, great. And KP is one of the best in the business, so great to have her on with us.
That's everything that we've got on J Sanderson TV, Roy. Before I let you go, we do want to say all the best to some of your clients who, as you sort of mentioned off air, they've been doing it tough over the last few months or few weeks with the Victorian lockdown. And I suppose any advice as they move towards another difficult time, which is tax time, particularly if there's any other snap lockdowns that we do incur?
Yeah, I think stay strong, talk to people, be open, be honest, and you've just got to plan for the future coming out of it. I just hope you're all coping well.
And hopefully we get some AFL back in Melbourne soon, so we can go to the footy again and enjoy what we started to enjoy at the start of this season. But Roy, fantastic to be with you again on J Sanderson TV. Thanks for coming in.
Thanks, Dave. Great again.
Thanks so much for joining us as well, to you at home, and look forward to joining you next time on J Sanderson TV.